What is typical hard money lender rates? All right, guys, we're going to talk all about hard money lender rates. But before I do, a big thank you to those who asked this question. I really appreciate it. And if you've got a question you'd like to have me answer, type it in the comments below, and I'll put a video like this together for you and for all my other amazing subscribers. Thanks for being a subscriber. So hard money lender rates. Well, let's just talk about this. What should you expect when you're dealing with hard money? The real answer is it depends. And it's going to depend on several variables. So let's talk about each one of these, and then I'll give you kind of an idea of some things to be looking for. So number one, it's going to depend upon your experience. The more experience you have, the less you probably end up paying. The idea is there's a little less risk if you have more experience and you've done this quite a bit. Second thing is how much money you're putting into the deal. The idea is the more money you're putting in, the less risk there is to a hard money lender, the more motivated they're going to be to get you a little bit better pricing. Next thing is going to come into what's happening to the repairs. Who's funding the repairs? Are you funding the repairs, or is the lender funding the repairs? See, if the lender's funding the repairs and you're putting down very little amount of money, they're going to want a pretty high interest rate to help compensate for that. So who's taking care of the repairs? Next thing that's going to come into consideration is loan to value. Meaning if you're buying a property for $50,000 that's worth $100,000, that's a very low or 50% loan to value. That's going to be, again, lower risk to the lender, and they're going to give you a little bit better interest rate because of that low loan to value that's coming in there. Some other things is going to be credit. Although most hard money lenders that are real hard money lenders don't necessarily care about the credit score, the better the score is, the better pricing they're going to be able to give you. Meaning a hard money lender will typically lend either way, but if your credit's really poor, they're going to say, we want you to pay more because your credit's poor. We'll give you the loan either way, but you're going to pay more for it. Whereas if your credit's like absolutely stellar, they're going to say, we'll give you a little bit better pricing. The other thing is got to take into consideration if you have bankruptcies, if you're had foreclosures, if you have collections and judgments, those are going to be really hard to overcome when you're dealing with hard money lenders. So I hope what you're experiencing here is this whole idea of risk versus reward. See, that's basically what the hard money lender is trying to understand here. The lower the risk the hard money lender has to take based upon you getting a really good deal, based upon your credit being really good, based upon you putting a lot of money down, based upon you having lots of experience, based upon you putting up all the money for the rehab, that's a really low risk loan. And based upon that low risk loan, you're going to pay a lot less for that, or potentially pay less for that. However, if you have all those negatives against you, you're going to plan on paying a lot more for that. We're typically seeing hard money rates ranging anywhere from a 12% on a hard money rate all the way up to like a 25% on a hard money rate based upon those variables and the answer to those questions. The better the deal is, the less it's going to be. The worse the loan is, the more you're going to end up paying for that. And so it's a combination of all factors. So, and it could even be less than 12% depending upon the scenarios there. So it really depends is the answer. Now, what you should be able to do, and one of the things that we've put together is a little software that you can put things into and says, this is what you should expect to pay based upon your scenario, because each one of these situations are a little bit different. What most hard money lenders do is they say, hey, call me, let me take a look at the deal, and then let's give you some idea on pricing. Now, I'll tell you, if you want to get a hard money lender really working with you, don't call them on every deal. Call them once you get a property under contract. Now, if you're enjoying this video, please hit that thumbs up button. It tells YouTube I am doing a great job, and I want to do a great job. What you may not know is YouTube does not let everybody see this video. They see a little portion of people see it, and then if there's thumbs ups and there's great reviews and that stuff, then they'll let a little more and a little more. So they release it out based upon how it's doing. So that thumbs up means a lot to me. Okay, so what we've talked about here are some different ways. Now, what if you have the bad credit and you don't have experience in some of those things? Really, you have two options. Option number one is find someone that does and team up with them to help you get better rates. Or the whole concept of hard money is lending based upon the asset, not lending based upon the individual. So you maybe scratch your head and say, Ryan, why are you talking about credit? And why are you talking about experience? Why are you talking about those things? Well, it's not a deterrent from you being able to get the loan. So you'll get the loan either way, as long as you're not in the middle of a bankruptcy, you're not in the middle of a foreclosure, you don't have collections and judgments. As long as you don't have those things, you'll get the loan either way. But the question is, and the question that came is, what to expect on the rate. And that's what's going to change drastically based upon what your circumstances actually are. It's back to a risk reward. Because remember, if you think about this, a hard money lender is not getting their money from the Federal Reserve at a 0% interest rate. A hard money does not have insurance that if things go bad, they get paid off. You may not realize that, but that's one of the things that happen, like with your FHA loans. The lender that actually gives the loan gets backing, is able to borrow from the Federal Reserve at 0% interest rate or some extremely low interest rate. And on top of that, if things go bad, they're able to collect on some insurance so that they lower their risks. See, hard money lenders don't have that privilege, and hard money lenders are having to come up with that money, either their own or they're partnering with other people that have money, and they're paying a much higher interest rate than 0%, which is why you're seeing higher interest rates than you would just going down the bank, or what you're going to see driving down the freeway being advertised with these super low rates. The other thing you have to take into consideration is hard money lenders are taking on more risk. You see, these types of deals are based upon a future value of the property. What's the property going to be worth after these repairs are going to be done? Well, what if these repairs don't get done? What if the contractor does poor work? What if the borrower doesn't follow through on this? What if they end up with a half-done property? Or worse, they end up with a half-done property where the quality of workmanship is so poor, it's got to get ripped out and put back in. You see, there is a lot of risk when a hard money lender is actually giving this loan. And so due to them not being able to have insurance against the loan, and we're not talking about hazard insurance here if the property has a fire or something, we're talking about lender insurance. They can't get that. They can't borrow at 0% interest rate. They take on the risk of what the property will become, not what it currently is. You see, most banks are saying, what's the property worth right now? We'll lend you based upon what the property is worth right now. And good hard money lenders are saying, what do we think the property can become? How much will it cost to make the property become in that manner? And we're lending based upon that value, which increases the risk for the hard money lender, which is why you're seeing those prices, those rates being a lot more expensive than what you're going to see driving down the freeway or anything else. Now, this gives you an idea of what you should be expecting. It gives you an idea of some things that you need to do. And as we talked about, you either need to pay the price of those higher interest rates, which is absolutely fine. It's a great way to get started, is actually just pay those rates, or you've got to find somebody that has some better criterias, better credit, some of those things, and partner up with you, and then they can help you get lower interest rates. I have found in most cases you're better off just paying the rates than you are partnering, because if you partner with somebody, they're like, well, I want 20%, or I want 30%, or I want half of it. Well, typically if an interest rate goes from 15% to 18%, it'd be cheaper for you just to pay that interest rate than it would for you to pay 50% to a partner. Now, those are all things you need to take into consideration, but these are some ways and some things that you should be expecting when it comes down to the hard money lender rates and what's out there. Now, if you would like to get a copy of my book, How to Get More Money You Can Ever Handle, A Real Estate Investor's Guide to Funding Deals, all you've got to do is text me your email address to 435-294-0433. I will send you an e-copy, or you can go on Amazon, Barnes & Noble, buy it for $25. I put a video together, what are hard money loan requirements? You're going to want to check out that video. In addition, I've got a blog post you're going to want to check out, the difference between hard money loans and soft money loans. I'll link that in the description below so you can check that out. Otherwise, make it a very profitable day, and bye for now.